This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril Hong in Singapore. Your top stories this hour. Asian investors assessing volatility in energy, commodity and FX markets, overshadowing modest gains in stocks and bonds. The dollar sinking on mounting speculation the US may help Japan support the yen. Also ahead, President Trump threatening to raise tariffs on South Korea to 25%, saying it hasn't enacted the trade deal they reached last year.
And I'm Stephen Engel at the 17th Annual Goldman Sachs Global Macro Conference in Hong Kong, where finance and industry leaders, policymakers, and investors will discuss topics, of course, affecting the global economy and markets. Coming up this hour, the bank's chief economist, Jan Hatzius, will join us. And later, you have to join us with our exclusive conversation with Chairman and CEO of Goldman Sachs, David Solomon.
And we're bracing for the market opens across Asia today after President Trump's tariff threats on South Korea. We have seen that market just on a tear, 95% plus gains when it comes to the Kospi, although the Korean won has continued to remain under pressure. And that to do partly because of that trade deal achieved during APEC last year and concerns that there might be capital outflows out of South Korea because of that $350 billion investment pledge into the U.S. Recently, we saw the Korean won being supported slightly because of the strength of the Japanese yen. Interestingly, it has tracked the yen more closely than the Chinese yuan, which is also holding steady. We have seen, of course, signals that perhaps the U.S. and Japan are coordinating in order to support the Japanese currency. So do keep an eye on what's happening here in Japan, with Nikkei futures now pointing to slight downside. We're seeing the staggered open in Australia also coming up higher 0.7%. Do watch out for this market coming back on a holiday. And of course, we had precious metal surging and gold topping $5,000 an ounce, Avril, so plenty to digest this morning.
Yeah, on top of that, these lines trickling in from South Korea that they will be holding a meeting to discuss steps on this tariff threat, although they're also saying that they didn't receive an official notice on the tariffs from the U.S. government. But I guess this policy volatility from the Trump administration is adding to the sense of global angst that has fueled this rally we're seeing in precious metals. Gold topping 5K. We got silver on its best surge since 2008, although it saw an intraday collapse. And all this against the backdrop, to your point earlier about the yen rally and how that has left the dollar, Bloomberg dollar index, lowest level since 2022. You are seeing U.S. Treasury yields hovering quite steady as they have been since late Friday. And then when it comes to the U.S. stocks, there has been that mild gain. And of course, this week is also going to be about those tech earnings. But for now, the focus on Trump's threats. Shery?
Yeah, let's actually delve into that with President Trump threatening those tariffs to 25% to South Korean goods. He says it's because the country's legislature has failed to codify the trade deal both nations reached last year. Let's bring in Troy Stangarone, non-resident fellow at the Carnegie Mellon Institute for Strategy and Technology. Great to have you with us, especially given that these news just broke a few minutes ago. Given that President Trump has only not threatened South Korea, but also European countries, also Canada. I mean, does it make you feel that a trade truce with the United States is not necessarily a long-term deal and that this could be a one-off that could also pass?
I do think this is something that could pass. We've seen with the case over Greenland and the tariffs on EU nations. We saw with Iran and the threat of any country to trade with Iran of a 25% tariff, that those ultimately go into effect. I think what we're seeing here is President Trump would like to see the agreement with Korea move more quickly than it has, though we're only about 3 months since it was finalized, so it's perhaps understandable that we haven't gone further than we have so far. But I think this is something that will likely pass. The Korean Prime Minister was in Washington recently. He spoke with Vice President Vance about where things were, so things should be on a solid footing. I think in terms of longer term, though, there is this question of what will hold. In the case with Greenland recently, we saw USTR Jameson Greer say that, in essence, that countries need to compartmentalize things, and there might be issues where the U.S. will put a tariff on a country while the deal is still in place. So I think this is the challenge going forward, is where will the U.S. expect countries to compartmentalize certain issues where it wants more and puts a tariff in place while the deal that they have already remains in place.
We're hearing that the South Korean government didn't necessarily receive any official notice on these tariffs from the Trump administration. When it comes to the relationship between Washington and Seoul, how detrimental could this be? Remember, even during the negotiations on the trade deal, we had seen that immigration raid in Georgia causing a lot of uproar in South Korea.
This is a relationship that I think we've seen some ups and downs with. You've had the downsides with the raid in Georgia. You have this potentially now. But there are upsides. The United States has referred to Korea as a model ally, one that it wants others to emulate. It's been happy with South Korean spending on defense. We've seen a significant development with the U.S. allowing South Korea to develop nuclear subs. So I think there has been some back and forth in this relationship, but this was something that would be a serious issue in South Korea. If these tariffs go back up to 25%, that then starts impacting businesses and puts Korea at a disadvantage to Japan and the European Union. So this is an important issue, but I do think this is one that we can resolve.
Troy, to your earlier point about how this could blow over and maybe this is all part of a negotiation tactic by the U.S. president, what can the Koreans do at this point to take things down a notch? Given Shery's point earlier that, maybe they want to also delay these investments into the U.S. given the impact on the Korean won, the currency.
Yeah. The won has definitely been one of the factors. It's slightly above where Korea is comfortable starting to move the investment funds that are pledged for this year over. But I think the first step is reaching out to Vice President Vance. We now have a hotline between Korea and Vice President Vance. And so getting a hold of the Vice President, seeing what is going on, what are the real issues here, and sort of taking and asking the Vice President to perhaps reach out to the President and calm things down is going to be an important first step. Beyond that, I think it's also important for Korea to perhaps clarify where things are in terms of their own progress. And that then will take and help President Trump better understand how things are moving forward and what he can expect going forward. But I think communication is going to be the key here. And as you noted, there hasn't been a formal notification sent. So one, we should keep that in mind, that nothing here is formal yet. But two, that I think communication is going to be important going forward on this issue.
We have been seeing the U.S. president sort of sharpen his swords or refine the use of tariffs as a tactic, as a tool. How much of this all then is a bit of a moot point as it all rests on a Supreme Court decision?
This is an important point. We're not sure when the Supreme Court will make its ruling, but when it does, and that's expected to be sometime in the near future, it will take and lay out whether this tariff could even go into effect. And so I think that's another point to keep in mind. At the same time, even if the Supreme Court takes and rules that President Trump doesn't have authority under Emergency Powers Act, so IEPA, to take and do these types of tariffs, the administration has already made clear that they will take and try to put tariffs in place. It'll take them longer. They will have to go through a process to do that. But so it might simply delay, but not prevent a tariff from going into place. But that being said, that delay would also give both sides more time to talk through any differences and make sure that any concerns are smoothed over. So I think the Supreme Court is another factor here, especially if President Trump is serious about moving forward with this tariff.
And to your point of South Korea being a role model ally, we have seen Seoul also trying to increase defense spending to 3.5% of GDP, which is one of the highest, if not the highest, among Asian peers. Given the geopolitical context that we're in, of course, the issues with North Korea also trying to rein in China's influence, for example, how more critical do the developments around this trade deal become?
I think it's important. Right now, Undersecretary Colby is in Seoul. He's talking through the changes in the national defense security strategy. And so a lot of this sort of is pinned on the idea of the U.S. having more flexibility on the Korean Peninsula, Korea taking on more of a role in terms of defense against North Korea, especially on the conventional side. This is something that President Lee has specifically said that Korea is willing to take on. But all of these issues start to come together. And I think as we look at how we're going to approach China in terms of deterrence, as we look at the situation on the Korean Peninsula, as we look at changes to how that defense posture is going to be put in place, it's important to not take and complicate those issues by complicating the trade relationship, especially if this is something to where there has been no indication that Korea does not intend to move forward with its trade agreement with the United States. And so this is really a question of timing rather than intent.
To what extent do you think, though, if there was a bit of a shift towards China, that Korea can signal this, given this very delicate geopolitical balancing act, as we saw with Lee Jae-myung's visits also earlier in the year to Japan?
Well, I think when we look at Korea's foreign policy right now, the initial visit to Japan before coming to the United States, and the first time a Korean president had gone to Japan immediately after being elected, was the critical visit in all of this. We've seen a situation to where South Korea has had difficulties with China in recent years. The informal sanctions that China put in place in regards to the THAAD deployment back during the Park Geun-hye administration hadn't actually been lifted. A lot of the cultural things related to K-pop were still in place. You couldn't necessarily introduce new movies or series into China from South Korea. And so there had been a lot of desire on the part of the administration to kind of move back to a more normal relationship with China. But I think the real key here is the willingness to continue taking and improving relations with Japan. It's important for both U.S. and South Korean security in the region. It's also important for Japanese security. And given the tensions that we've seen over pretty much the last decade between Japan and South Korea, to see go from the Yoon administration, where there's criticism of this shift, into the new Lee Jae-myung administration, where President Lee had actually originally been a critic, that is the biggest shift that we've seen in foreign policy under the Lee Jae-myung administration.
Troy, it's been so good getting analysis from you. Thank you so much for this and for taking the time. Troy Stangarone is non-resident fellow at the Carnegie Mellon Institute for Strategy and Technology. Now, we've already been seeing some pre-market reaction to Trump's threats of tariffs on these auto stocks, pharma-related stocks as well. Those are the sectors that he's threatening 25%. Let's bring Bloomberg MLive strategist Mark Cranfield. Mark, what is your read, first of all, and the instant reaction to all this?
Well, traders are watching a tennis match here, and Trump has just whacked the ball across to the South Korean side, and they're now waiting to see what the response is from the Koreans. And it may well be that if they come up with some wording which it placates President Trump, everything will calm down fairly quickly. So investors are waiting to see the response, because it is a threat so far that he will raise the tariffs, and not actually happened yet. And of course, when you consider that it's not just simply about the threat of tariffs on the autos. What it seems to be in the background, what it's more about, is these big investments into the United States. So President Trump last year spoke to Korea, Japan, Taiwan, all about these major investments he wants to see them undertake in the United States. And all of that seems to be moving a bit too slowly for him. So that's making everyone a little bit edgy about. So if the Koreans come forward and they suggest they can get on with that, markets will probably calm down. Initially, we're probably going to see quite a bit of volatility in the Korean markets, and probably precious metals as well, because we're coming towards month end. January has already been a spectacular month for silver, for gold, and for the Korean equities. Kosdaq was up 7% yesterday. There's plenty of reason why people would want to take a step back, lock in some gains, and move on to the next month. So we're likely to see stocks come off a bit today, and it probably will filter across to metals as well.
I mean, Korean investments, for example, to your point, are supposed to come in slowly into the U.S., right? Capped at $20 billion because of the pressure on the Korean won if this trade deal is ratified by Parliament. We have seen that immense pressure already on the South Korean currency. What are the dynamics right now at play in Korean FX markets, not to mention as it relates to, say, the Japanese yen, which is a competitor with export peers, and also the offshore yuan, which it usually used to track more closely, but now it seems to be that the yen is more influential?
Well, as you say, the relationship with the yen at the moment is far more important than any other. The fact that we appear to be going into a period here where there's broad dollar weakness taking place, which the United States seem to be fairly happy with. Scott Bessent seems to be fairly relaxed at the idea that the US dollar can trade a bit lower. Investors can see that. And so we're gradually seeing an erosion of dollar strength, which we'd seen at the beginning of the Trump administration. So the fact that the yen has improved quite a bit over the past few days, that will filter through to the Korean won and other Asian currencies as well. We see the Malaysian ringgit and the Singapore dollar hit multi-year highs in the past couple of days as well. So there'll probably be less impact on the Korean won unless there's a massive turnaround by foreigners into the market there. That will probably be on the sidelines as the US dollar is relatively weak. It's more about where the really speculative flows have been. Things like the Kosdaq index, precious metals as well. Those are the ones where if the hot money comes in, hot money flows out. And those are the ones that will be most at risk rather than the currency.
You talk about the yen. What are you watching next in terms of follow-through so we see even more of a rally this week?
Yeah, it's unlikely that they can sit back and do nothing more. I mean, one rate check from the Federal Reserve last week is useful, but it's not enough in itself. The Japanese authorities need to be a bit more forceful. They're probably waiting to see how this 40-year JGB auction goes tomorrow. It's a major event in Japanese markets. It was just a week ago we were talking about the massive dislocations being caused globally by the turmoil in the long end of the Japanese market. That has calmed down for a moment with help from the US and the yen getting a bit softer as well. But this auction still has to go ahead. 40-year auctions are notoriously difficult. The market is in a better condition. Doesn't mean to say it will move completely smoothly. The Japanese authorities will probably like to see how it plays out, because if it performs badly in the secondary market, it will spill back into the currency. We've seen the link between JGBs and the currency many times over the past few weeks. So they probably want to see the effect of that if they need to come in afterwards.
And I mean, it won't help that we do have political campaigning, which starts today here in Japan. Bloomberg and Life strategist Mark Cranfield there with the latest on what to watch in the markets. And coming up, we're live from the Goldman Sachs Global Macro Conference in Hong Kong with the bank's chief economist, Pictet Asset Management, explaining why they don't see stock valuations in bubble territory. Plus, Blue Owl Capital also joins us about investing in Australia. This is Bloomberg. President Trump has indicated he will make changes to his administration's deportation crackdown in Minnesota. This follows nationwide uproar over the killing of 2 U.S. citizens during immigration raids. Let's bring in Bloomberg digital politics editor Romy Varghese. Romy, the political risks are growing for President Trump, especially ahead of the midterm elections.
Absolutely. You know, we are seeing poll after poll come out and show that Americans, even if they support deporting people who are in the United States illegally, they do not like these aggressive tactics by immigration and enforcement. They're not liking these aggressive tactics that we're seeing ICE officers do on the streets. And this is coming at a time when, Republicans are trying to hold on to their majority in the House. And with the November elections coming up, they don't want to, have anything interfere with their ability to hold on to the House. And, Democrats are even hoping they could flip the Senate. And with these videos coming out, showing these aggressive tactics, Trump is losing the opinions of, losing the ratings over here. I mean, we see his polls overall hovering near the lowest it's been.
Romy, we're also seeing the U.S. proposing holding payments to private Medicare plans flat. This is for next year. How much of a surprise is this?
This was a huge surprise to analysts. I mean, they were expecting an increase as much as 6%. And, this is bad news for these companies because, they feel like rising expenses are cutting into their profits. And actually, it's going to affect what seniors are going to be getting from their plans because they will have little incentive to increase the benefits they offer to their seniors.
Romy, thank you so much for bringing us the latest. Bloomberg digital politics editor Romy Varghese. Let's take a quick look at how futures are shaping up for the session. Nikkei futures pointing to those declines now. This is ASX 200 surging perhaps on what we're seeing, the rally in metals. Now, talking about tech as well, because Microsoft has unveiled its next generation AI chip. The Maya 200 is part of a push to power services more efficiently and reduce reliance on Nvidia products. Our Asia tech correspondent Avril joins us now from Hong Kong. Belle, what else do we know?
Well, we know, of course, that the modus operandi essentially for any sort of cloud computing provider out there is to have better models, better performance, lower cost as well, to try and increase that adoption of its products. So to that end, Microsoft has just unveiled or is rolling out now what's called the Maya 200, as you said. It's their latest generation AI chip, and they're saying that it's new AI silicon that's been designed specifically and optimized for inferencing very large models. So that includes both reasoning as well as chain of thought models. Now, just to get into some of the technical features of it, it has huge compute ability. It's been made with a large amount of HBM as well. It's using TSMC's, that's the fabricator, of course, TSMC's 3-nanometer process. So just suffice to say, at a headline level, it's going to be faster, more powerful, the Maya 200, compared to the first generation of that chip. So Microsoft is also saying that this actually is going to be cheaper than what's been made previously, because they're saying the Maya 200 is 30% cheaper than any other AI silicon on the market today. So the goal here is to help Microsoft reduce its inferencing costs for its Copilot, its AI agent products, and then off the back of that, as I said, potentially boost more adoption over the next 12 to 24 months. That's the view of Bloomberg Intelligence. But certainly you did see at least some upside for Microsoft in the session today in what was otherwise a bit of tech under pressure.
In the meantime, Bell, Nvidia itself has upped its investments in its key customer CoreWeave. What's behind the move?
Yeah, that's right. This is a really long-standing partnership. These companies have been, or Nvidia has been actively investing in CoreWeave for a number of years now. But just yesterday in the session, we had this announcement that they're looking at a $2 billion additional investment into the company. So essentially buying up stock at $87.20 per share. You did see CoreWeave rising off the back. Again, Nvidia a bit under pressure. But essentially, CoreWeave is a cloud computing firm. It's a key Nvidia customer. And the idea of this investment is to help build more than 5 gigawatts of AI computing capacity by the end of this decade. So we did see that share price reaction, as I said, CoreWeave actually rising pretty well throughout the day. And certainly it does have ramifications for Nvidia as well, because it puts that spotlight on their new business avenue, which is the CPU, which is carrying the Vera brand. But it is the first time the company is going to be offering that chip on a standalone basis, and CoreWeave is going to be integrating that quite soon.
Annabelle Jewelers there with the biggest tech news today. We have more ahead on the Asia trade. This is Bloomberg.
Now, we have been seeing that rally in gold topping 5K. Today, after a long weekend, Australian markets are getting their first chance to react to that. So we are seeing the surge in these gold-related stocks, but also against the backdrop of metals doing well overall. And you are seeing some of the other miners, including the likes of BHP, Rio Tinto, also green on the screen. By the way, if you're looking at the Australia Materials Index, is at the highest level since late October. Shery?
And take a look at how some of these stocks are trading pre-market in South Korea after President Trump threatened to hike tariffs on Korean goods to 25%. These companies are in sectors that will be affected by the new rate: autos, lumber, pharmaceutical products. South Korea says it didn't receive official notice on tariffs from the U.S. government. We'll be watching the open today after that immense rally that we've seen both in the Kospi and the Kosdaq lately. We have more ahead on the Asia trade. This is Bloomberg.
This is the state of play across currencies a day after that sharp rally in the yen amid the risks of intervention. We are also seeing, of course, the Bloomberg Dollar Index sliding to the lowest level since 2022. We'll be watching the Korean won reaction following Trump's fresh threats of tariffs on the South Korean nation towards 25%. For more, let's bring in Bloomberg FX and rate strategist David Finnerty. So, David, we've been watching keenly, as you have, the yen rally and how that has had release valves elsewhere. It seems like the key among them is the slide in the dollar. Does this have legs? Do you think the factors driving this have more to run?
Potentially, there's always a caveat, but I think there is some potential to this. You said at the moment, it's like the attitude towards the dollar isn't great. You have the US shutdown looming, which is going to be another temporary dollar negative. Attitude towards the dollar is suddenly changing slightly. Obviously, trade war, politicization, everything that's going on. It's not the nicest asset you would say at the moment to invest. And at the moment, a lot of traders say, look, the trend is your friend. And if the dollar's getting weaker, you go, well, why would I try and fight that one at the moment? Particularly if the Federal Reserve Bank of New York last week did a rate check. That doesn't happen that often. So when they get involved, you go, okay, now the game has changed slightly. You know, is there signs that maybe the US government doesn't want the dollar to weaken, to strengthen certainly, and maybe is it encouraging it to weaken slightly? So when you add all these things together, I think there is room for it to go down near term. Having said that, there are, you have to look at the US data. You have to see how the Fed comes out this week. How hawkish does it sound? The market's looking for 2 rate cuts. If it says, well, maybe not 2, maybe more 1, then you may see the dollar rebound slightly. But certainly at the moment, risks that you would say are skewed towards dollar weakness in the near term, at least.
David, dollar weakness doesn't necessarily mean strength for Asian currencies like the Japanese yen and the Korean won, do they? I mean, we saw some signals of coordinated action between Japan and the U.S., and we thought that the yen was going to potentially continue to strengthen, which would have boded well for the Korean won, which has tracked the yen very closely. But with these tariff news now, that seems to be thrown out the window.
Yeah, certainly on you take the one first. The news of the tariffs obviously is not good. It would impact the Korean economy. And I think the other thing to spin forward is this also a warning to other countries? If you don't play game as well, we'll actually quickly raise tariffs as well. So I think this may be part of a bigger picture, while at the moment the won's in it. So that's certainly negative for the won. And he said, going back to the yen, yes, obviously the yen rallied from 159 down to the basic 153, just above 153. And now it's sort of halted. It's around 154 level. And because the catch is, okay, if you go back to last week, what happened between last week and now, what's really the big difference? On the Japan side of the equation, you go, well, not a lot's really changed. So the reason why I was buying dollar yen from the Japan side of the equation, well, they're still there. We're still worried about re-election. We're still worried about what Takaichi will do in terms of spending plans. We're still worried about the BOJ, not in no hurry to hike. So that's not changed. What has changed, though, is the dollar part of the equation with the Federal Reserve Bank of New York saying, okay, we are prepared to have a coordinated effort and intervene. So it does sort of cap the upside to dollar yen, you would think. But then again, for the downside, you go, okay, you've had your move. If you're not going to intervene, how much lower can you go? Can dollar yen go now, given that I still have these Japan side of the occasion problems? So I think the market's trying to see, do I drift back up, which historically it does do in these circumstances after a warning. The only gambit is now, it's a bit unusual because now we go, this could be a coordinated policy. And the risk is if dollar yen starts drifting higher, does the Federal Reserve Bank say, you didn't listen to us, we will now intervene? And remember, Bank of Japan has X dollars to sell. The Federal Reserve Bank of New York has an infinite amount of dollars to sell. So really, this double-sided thing does maybe put a cap on dollar yen, which maybe helps support the won a bit. But as you said, going back to the won quickly, with the news of the tariffs, you just go, look, that's not positive. If, though, President Lee comes out and says, look, we will pass stuff quite quickly, those tariffs could fade again. So you're seeing, most people see a knee-jerk reaction to it. How much legs this does have to it is very variable, given that, go back to the dollar side of the equation, we have the Fed looming, we have a government shutdown looming. So there's a lot of catalysts here, moving parts of the story that could affect how these pairs move in coming days.
And then you add to that the carry strategies that we've been seeing. I mean, as investors sell the dollar, they've been buying EMFX. That is also trending at those highs, right? What are you seeing in carry strategies now?
Carry's always been popular. In fact, when I was in London talking to traders towards the end of last year, all they were basically saying was carry, carry, carry. And, certainly the three carry trades that pretty much everyone had at one point was the Turkish lira, the Brazilian real, and the South African rand. And then there was other ones, well, Mexican peso. But certainly those three were coming up continually when I was in conversations. And I think carry now remains attractive. Certainly if you look at something like Brazilian real, you've got a central bank with rates at 15%, inflation down towards, say, 4%. So on a real rate basis, you go, that's very good. The Brazilian real's been appreciating versus the dollar, which adds to the return of the carry. So some of these trades, you go, look, why change what's been a winning trade? So given the volatility or uncertainty, a lot of hedge funds like directional trades. And at the moment you go, well, which direction may they go in? Because I don't know where the dollar really is going. Yes, it's going weaker. Could it turn around quickly? Whereas the carry trades offer a bit more stability and offer some decent returns if you're looking at Brazilian real or Turkish lira as examples. And those currencies, as I said, certainly Brazilian real, it's actually been appreciating. So it really does increase the allure of investing in it from a carry perspective. So carry trade is not going anywhere, and the culprits, or the favourites, I should say, are still out there. Said real, Turkish lira, Czech koruna, Mexican peso to some degree. So certainly in Latin America, those trades are still very popular.
David Finnerty, always good to get your views. Bloomberg FX and rate strategist with what to expect in the market session today. And the top global headlines that we're following, India's Commerce Secretary says negotiations on a free trade agreement with the European Union have concluded. Rajesh Agrawal says the two sides will announce details on Tuesday. It's expected the pact will be formally signed after legal vetting, which typically takes around 6 months. Agrawal says the deal will foster better economic partnership with the EU. China has reminded its citizens to avoid traveling to Japan during the Lunar New Year holiday, which falls in mid-February. According to Xinhua, Chinese citizens are facing severe safety risks. Chinese airlines say they will continue waiving flight cancellation fees for Japan until mid-October. Tensions are high after Prime Minister Sanae Takaichi's comments last year on Taiwan. An Iranian news agency says Foreign Minister Abbas Araghchi is exchanging informal messages with U.S. Special Envoy Steve Witkoff. An Iranian ambassador says the two sides are in contact, but don't currently have a fixed channel of communication. It's the first official confirmation since Iran's deadly wave of protests that Washington and Tehran are actively in touch.
Shery, also ahead, our exclusive interview with the U.S. ambassador to China, David Perdue, as President Trump prepares to visit Beijing in April. That interview coming up on Insight with Haslinda Amin at the Times on your screen. But first, we take you live to the Goldman Sachs Global Macro Conference in Hong Kong to speak with the bank's chief economist, Jan Hatzius. More ahead on the Asia trade. This is Bloomberg.
The annual Goldman Sachs Global Macro Conference begins in Hong Kong today, bringing together top finance and industry leaders to discuss the issues shaping the global economy and markets. Let's cross over to the event where our Chief North Asia correspondent Stephen Engel is with our first guest. Steve.
Yes, we're setting the table here of our coverage, exclusive coverage of the Global Macro Conference of Goldman Sachs here at the Four Seasons in Hong Kong. And we are welcomed by Jan Hatzius. He is the chief economist at Goldman Sachs and the head of the Global Investment Research Group. Thanks so much for joining us.
Yeah, it's great to be with you.
Well, let's start with the U.S. and we'll pivot into China. We'll talk about a lot of different things, including your outlook for gold. But in the U.S., you among the big banks seem to be one of the more optimistic towards the U.S. economy and on inflation, but a little bit more bearish on the labor market. Give us your top-line view of the U.S. economy this year as all eyes are on that economy.
Yeah, it's, I think, a combination of a good growth outlook where we are at almost 3%, 2.9% for annual average growth this year. The consensus is, Bloomberg consensus is only 2.1%. So it's a pretty big gap. It's really driven by tariffs receding into the rearview mirror as a drag on growth. That was the big story of 2025, with the big increase in the average tariff rate by about 10 percentage points. We think that's behind us, and from now on, we're looking at stability or maybe even some tariff declines, and we can get into that.
So the pass-through is pretty much peaked?
The pass-through, I think, is peaked, but there's still some more to come. We've seen about 60 basis points of impact on the price level. We think we might get another 20 or 30 basis points, depending on what happens to the tariff rate. But that was a drag on growth. It was a boost to inflation. It's going to become less dramatic as we go through this year. And in fact, from an inflation perspective, the impact is going to diminish in the second half of the year when we start to anniversary those tariff increases.
Isn't there a lag effect to the inflationary impact? Especially, there was a lot of front loading from China when Liberation Day came in April, and that perhaps we could see spikes in the beginning part of this year in inflation.
In the month-to-month numbers, certainly possible. There could be a start of the year effect. Sometimes price increases are sort of compressed into particular months. So I don't rule that out. But I'm pretty confident that the biggest effects on tariffs, on inflation from tariffs, are probably behind us. And especially as we get into the second half of the year, the impact is going to diminish from an inflation perspective.
What is going to be the impact on sentiment as well and trade flows when we get headlines like today, where Donald Trump is threatening an increase on South Korea on tariffs from 15 to 25%? What message does that send to other trading partners who think they've already had a deal in the bag?
We're still in an uncertain environment, no doubt. That's true geopolitically, and it's true in terms of tariff policy. And those kinds of spats and headlines could certainly occur again. But I think the bigger picture is that the big increases are probably behind us. We're moving towards the midterms. Affordability is a huge issue in the US. That creates an incentive not to sharply increase the average tariff rate further from here. There's also the question of the president's tariff authority. With the Supreme Court decision that probably will come at some point in the not too distant future. We thought it might already have come. At this point, we're thinking February. That could put some constraints on his ability to put on tariffs. So again, the big picture, I think, is in the direction of this being less of a headwind.
On this vein, then, as well, we can talk about Fed independence and the silent splits, if you will, between the board members and non-executive members, essentially on where to go. Jay Powell essentially says the Fed, has the labor market to take into account, as well as obviously the inflationary specter, where many people are split on whether they need to cut further. You say 2 cuts, probably in the later half of the year rather than the first half of the year.
Yeah, and that's really driven by our view that, one, the strength in GDP growth isn't fully going to pass through into the stronger labor market because we've seen a big productivity acceleration. So we think the unemployment rate is still going to be in the 4.5% range in the second half of the year. And number 2, and even more importantly, we do expect inflation to come down to somewhere close to the 2% target by the end of the year. And that, again, relates to the tariff pass-through issues that we just spoke about, but it also relates to the fact that underneath the tariffs, we've seen continued disinflation. Wage growth has continued to come down. Rent inflation has continued to come down. I think that should get the majority on the FOMC comfortable with some additional cuts in the second half. I don't expect anything this week. I don't expect anything in the next few meetings. But the second half of the year is a different story.
What are the biggest risks to the U.S. economy right now? Is it the labor market? Is it the government shutdown that's possibly looming? Is it the geopolitical headwinds, obviously?
You've mentioned, I think, the 3 biggest ones, and they're obviously, operate at different time horizons. If there's a government shutdown, that is going to have a mechanical negative impact on the economy. It's also going to make our life as forecasters more difficult because we'll again get a shutdown of government data. The geopolitics continues to be very, very unsettled. Tariffs can play into that. There's some overlap between geopolitical spats and tariffs in some cases. And then the labor market from an economic perspective, I think, is probably still the biggest risk, although I've become incrementally a little less concerned about a sharper labor market downturn. I thought the biggest risk of that was really over the last several months. And when we didn't see it in the most recent employment report, we actually took down our estimate of the risk of recession over the next 12 months from 30% to 20%.
20% chance of recession in the United States. All right. As the hedge, a lot of investors going into gold. I want to get to China in just a minute. I hope the producers save a little bit more time for me. But gold, obviously 5,000 spot price an ounce on gold. Is 6,000 the next target?
Our forecast is 5,400, but we have said, and our commodity strategists have said, that the risks to that are still significantly on the upside. Why is that? It's because the primary source of demand for gold, namely the buying from central banks that are trying to diversify their reserve portfolios, that's still underway. That we think that's going to continue. And now we're also seeing more investor demand. That's obviously a more fickle source of demand that could shift, but we still think that the boost from central banks is going to continue.
A nice segue, because the PBOC is widely believed to be also buying quite a bit of gold. What's your outlook for the Chinese economy as they try to rebalance? They're still a heavily export-dependent economy.
We're also on the optimistic side as far as the headline growth numbers are concerned in China. Not quite to the same degree relative to the Bloomberg consensus, but we're at 4.8% versus 4.5%. It is a more split story because we have a very strong external sector, remarkable export growth numbers in 2025.
Did that surprise you?
It did, yeah, for sure, yes. It really underscored the resilience of the goods-producing sector, and we raised our numbers on the back of that because it was a real test case of how strong the Chinese manufacturing sector is.
How much longer can they rely on that pillar, though, and they need to boost domestic demand?
Well, that's the flip side of the story. And on domestic demand, the news has continued to be quite negative, and certainly as far as housing is concerned, but also retail sales have been sluggish. And then there's a question of the impact of China's export strength on the rest of the world, right, which is eating into the market shares of export-oriented economies, especially in Europe, Germany, where I grew up, and a number of other export-oriented economies are being affected by this.
Do you expect significant pushback, though? Continual pushback? Or has there been...
I think there will be some pushback. It's difficult, though, because China has the ability to deter pushback, in part because of its control of rare earths and critical minerals.
Very quickly on Japan, obviously there's been a lot of bond volatility of late. The yen has been appreciating. Maybe that's because of increased coordination with the New York Fed at the behest of the Treasury, which is a new interesting tact by the BOJ, obviously, by the Japanese, to stem that depreciation of the yen to 160. It's now 154 and change. What's your outlook? Has the heavily fiscal policies of Takeichi-san, does that change your equation about how you look at the Japanese economy?
Well, I'd say the near term is, of course, very, very tactical in the run-up to the election in February, in a couple of weeks, in an environment where intervention may occur, where we have seen sort of the early signals of that. The big picture, I think, is one in which the Japanese economy is normalizing. Underlying inflation is getting closer to 2%. I still think it's below 2%, but it's getting closer. Yeah. And the economy is growing at a more steady 1% kind of pace. In that sort of environment, we still have relatively low interest rates. Policy rates are 75 basis points. Even the 10-year yield is 2.2%. That's not that high, right, relative to nominal GDP, maybe in the 3% range. And of course, the currency is very far out of balance if you just look at it from a purchasing power perspective.
So what should it be, 140?
I mean, from a purchasing power perspective, the IMF estimates that purchasing power parity is 94. So we're very, very far away from that. Now, there are good reasons for being away from it, but maybe we shouldn't be this far away from the longer-term equilibrium. So it's going to continue to be very interesting in Japan.
Jan Hatzius, thanks so much for setting the table for us. We went around the world in 10 minutes. Thanks so much.
Indeed. Thank you so much.
Avril, we're going to send it back to you as we kick off our coverage exclusively here at the Global Macro Conference of Goldman Sachs.
A really comprehensive conversation, Steve. Thanks so much. Stephen Angle in Hong Kong. Stay with us for more from the Goldman Macro Conference, including interviews with DreamWorks co-founder and former Disney chairman Jeffrey Katzenberg. Plus, we speak to the Goldman CEO, David Solomon. We also have some news crossing the terminal, and this is in relation to Anta Sports, the Chinese sportswear maker, of course. It's set to buy a 29% stake in Puma for €1.5 billion. And this pretty much confirms a scoop from Bloomberg from late last year. More ahead on the Asia trade. This is Bloomberg. Let's take a look at how Asia markets are faring in the early goings. We might see a bit of that spillover effect from the Korea threatened tariffs, and amid the backdrop of whether this prompts a bit more focus on some other economies that have been seen as slow in implementing the investments into the US. So the likes of Japan and Taiwan, I should say, will be in focus. But of course, we'll be watching Japan stocks against the backdrop of what we've been seeing in the yen's rally, the strength there, Shery.
Yeah, and I'll be really curious to see what happens to the Korean won, because the yen strength has led to some support for the Korean currency. But you can see right there some of those big movers in areas that can be affected by that 25% tariff threat coming from President Trump. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and bracing for the fallout of President Trump's tariff threats of 25% on South Korean goods. So we'll be watching sectors like autos, pharmaceuticals, lumber as well. And of course, a broader risk-off sentiment that we could see potentially across Asia, Avril.
Absolutely. And already we've been seeing the factoring in of this volatile policy from the U.S. president. And perhaps that is driving global angst and the flows towards some of these safe havens. Think about how gold has been reacting. His comments on South Korea, just another reminder of this, Shery.
Yeah, even the Japanese yen saw a little bit of a boost on that safe haven demand, right? Despite the fact that the yen has really not acted as a safe haven in recent years. But we have seen the boost, especially from signals of coordinated action between the U.S. and Japan in order to support the Japanese currency. You can see the Nikkei at the moment not doing much, but the topics losing about 0.25% already. We have seen a day of losses in the previous session as well. And do keep an eye on the JGB space. Not necessarily anything happening today, but we do have a 40-year auction coming up later in the week, which is critical in that test of demand, given that also political campaigning, election campaigning starts today here in Japan. It's been the concerns about government spending that have really led to that JGB meltdown early last week. But take a look at how South Korea is coming online. That market, of course, has been on a tear, with the Kospi gaining more than 95% over the past year. And we had seen the Kosdaq even surging to the highest level since 2000. You can see the Kospi under a little bit of pressure. And there are some sectors that we'll be watching very closely. The auto sector, lumber, pharmaceuticals as well, that are now being threatened with 25% tariffs from President Trump. Also, those reciprocal tariffs that could be raised to 25% as well. President Trump not happy with the fact that South Korea's legislature has yet to pass that U.S. trade deal that was signed last year. But remember, it was also this trade deal that led to concerns about capital outflows, given that we're talking about a $350 billion investment into the United States, and that led to the pressure on the Korean won. And you can see right now, pressured more, 1450 is your level.
Yeah, despite that pressure, though, it's interesting how mild the market reaction has been. I mean, we were perhaps expecting a bit more of that coming through in the Korean won, but maybe capped because of the rally in the yen and how that has also prompted the weakness in the dollar. You're still seeing the Bloomberg dollar index hovering near those 2022 lows. We will be watching, of course, this week when it comes to stocks, the reaction to earnings, because it's a third of the S&P 500's market cap that reports this week, don't forget. And given how things have been trending, it looks like, based on JP Morgan analysis, that they have been beating forward guidance. So that bodes well as we see perhaps also that bit of rotation to other sectors apart from tech. Gold continues climbing past the 5,000 handle, extending those gains there. Shery?
Yeah, really precious metals on that tear, on that geopolitical tension, safe haven demand. Let's get more perspective on the markets. Joining us now is Luca Paolini, Chief Strategist at Pictet Asset Management. Luca, really good to have you with us, especially on the day when we have new tariff threats, on top of course, what's happening between the U.S. and Canada, between the U.S. and European countries. How consequential could the latest threats on South Korea be for broader risk-off sentiment that could be more sustained in the days ahead?
Well, good morning. I don't think this threat is going to have a big impact. We have learned from the past that, Trump loves to threaten, but then he backs down. I think this seems also to be a more technical in nature, talking about the legislative process is not really fundamental. So I think, yeah, of course, market has been very strong recently, so some kind of a pause of profit taking is likely, but I don't think it will have long-lasting impact on markets.
At least when it comes to some of those sectors that are being targeted, autos, pharmaceuticals, for example, they've not just been targeted, but they've been just very vulnerable to these trade negotiations ongoing since last year. Should investors be a bit more careful approaching these sectors, not only in South Korea, but across Asia, here in Japan as well?
Well, again, there is obviously a risk, and I think, to me, though, the real kind of risk here is more like on the currencies, in the sense that I understand that Trump is trying to threaten, obviously, with tariffs, but I think the real kind of target from the President Trump is to have all the Asian currency to appreciate. I think this will have a more long-lasting impact. I think it's more realistic to expect, and we see that also in Japan, the Japanese authority is playing the same game. So I do think that the impact is more on a currency level, while in terms of earnings, in terms of impact of the overall market, I think, especially in the equity market, should be very contained in almost, I would say, every sector.
If that's the case, how much further do you see the dollar falling?
Well, we are very bearish on the dollar for a lot of fundamental reasons. The dollar is still expensive of almost any measure. The Fed is probably is likely to cut rates. The U.S. economy is strong, but not as strong as it used to be. And we see this kind of de-dollarization trend that goes on. So there are, let's say, fundamental reasons, more long-term and short-term reasons why we expect the dollar to continue to decline this year as well.
As investors rethink U.S. assets, their attractiveness, what do you make of what we're seeing in stocks? I mean, this week we're watching out for earnings from the big tech names. We might see U.S. stocks versus, say, Japan or Europe peers continue their underperformance. Is that also your read of the situation?
Well, we do think that, the earnings picture is very, very solid, not only in the U.S. We see inflation going down, interest rate going down. This is a very bullish backdrop for stocks. Having said that, we see more potential outside of the U.S. because this is where I think there are more upside risks, I do believe. And I do believe also that when we look at the tech sector, again, yes, the temptation is always to say, well, this is a bubble. But the reality is that all these companies that are still making a lot of money, and we are just at the beginning of a significant long-term upcycle. So I do believe that the risk here is to sell too early, and we do believe that fundamentals remain strong for the tech sectors, even if we prefer to be invested more in other sectors, because we do believe that the value sectors will continue to outperform.
And value sectors in which markets are we talking about? Because, of course, when we talk about tech, it's not only about U.S. tech that has seen that significant rise. We're also talking about Chinese tech, which has seen significant interest in recent months. Could we see some value sectors in that market, for example, when the broader economy still remains pretty lackluster?
Absolutely. We don't think that the best way to play this tech or AI cycle is just to invest in U.S. tech stocks. I think we want to invest in Asia. Not only, there are even some potential interest names in Europe and Japan. So we want to broaden out the team. And I do believe, though, that the general trend is up. And there is no question that in some parts of the market, the Chinese players are incredibly strong, innovative, and also cheaper than their U.S. peers.
Luca, are you seeing the events so far in January, whether it's Venezuela, Greenland, Iran to some extent, now these tariff threats, is that also driving more towards Chinese assets?
I think so. In a way, what we are experiencing here, well, we've seen this before in a way. The U.S. playing our ball here with tariff threat and all the other things. The reality is that China in this environment seems to be almost like a safe haven. And I think it's important to highlight that China seems to be an area of stability against, let's say, the West, especially the U.S., where there are these constant threats and all these kind of things. So I do believe that there is some truth in the idea that the Chinese market, in this very volatile environment, politically volatile environment, geopolitical volatile environment, the Chinese stock market seems to be relatively a safer option than other markets.
Luca Paolini, really good to have you with us, Chief Strategist at Pictet Asset Management. We continue to keep our eyes on the Korean markets, and we are seeing now the Kospi losing ground at the moment, but the Kosdaq actually gaining ground. Remember, we have seen that divergence in these two sectors, with the Kospi having rallied more than 90% and the tech-heavy and small-cap Kosdaq actually lagging. But in the previous session, it actually jumped to the highest since 2000. And today, you're seeing those stocks at the moment, automakers, pharmaceuticals, taking a hit because of President Trump's tariff threats. But that divergence right now continuing in the South Korean market, very interesting, as investors are now trying to really look at other parts of the market to continue investing. Still, the looming cloud right now on South Korea is the ongoing trade issue with the U.S. The deal was signed last year, but President Trump doesn't like the fact that he hasn't passed South Korea's parliament as of yet. Let's get to Seoul Bureau Editor Danny Thomas for the latest on this. Danny, what did the president exactly say that he wasn't about, and why South Korea?
Yes, a good question, and everybody in Seoul is equally flummoxed by this sudden development. There was no notice given to South Korea, and presidential office is now scrambling to make sure that there is an adequate response. There's a meeting that the presidential chief of policy will hold today, and you will also hear from the president later during the cabinet meeting. But it broadly looks like a technical delay. This code was introduced in November, right after the two countries reached the deal, and it has to go through the parliament process, which hasn't reached its conclusion. So that's a bit of a surprise, and how you negotiate that and how you convince that is going to be the next few challenges. And it comes right after just when everybody thought that the trade tensions have kind of subsided and we are getting on even keel. So yes, it's come as a surprise, but how South Korea responded to it previously and how it's going to deal with it is going to be a new challenge for the president and the team here.
Are we getting a sense of maybe what they can do to sort of placate the situation with the U.S. president? Might that involve speeding up the investments into the U.S.?
So I think there was some confusion whether the committed $350 billion that Korea has committed, will that, the first tranche of that will go through or not. But the finance ministry last week was very clear that there is no delay to that. So I don't think that is going to be an issue. I think it's a technical matter, and what the South Koreans will try to do is explain how the parliament works and how the various aspects of the bill would need to go through the parliament process, and that should hopefully convince Trump and the US government that there's not a delay, it's just that it has to follow a procedure. So that would be the South Korean response to it, to convince, to make sure that they understand how the parliament process works here, and it's not any effort to delay what they agreed to. I think the message that is being sent around from the truth message is that, well, South Korea is not holding up to the trade agreement, which is not the case, and I think South Korea should get up to speed and say, look, this is a process which will take time.
How will this sit with the South Korean public, given that we had already seen them outraged that their strongest ally carried out that humiliating immigration raid in South Korean companies in Georgia last year?
Yeah, look, that's a good question, and there has been a lot of frustration here that despite being the closest ally, the historical nature of the relationship, Trump has treated South Korea not with the due respect. And this again raises the same question, whether you can South Korea continue to trust. I think there has been some resolution to that, but these kind of abrupt nature of the messaging that comes through will again raise these questions. But overall, I think the two countries are kind of aligned on what they want to do and how they want to take the relationship forward. I think the whole $350 billion commitment and South Korea's effort to revive the U.S. shipping industry, all those are pretty big commitments that the two countries have agreed to, and these would be seen as kind of minor, errands on the way, and not as a big flip of the whole policy decision between the two countries.
So they are aligned, the U.S. and Korea, perhaps more about convincing the U.S. president that they are. Denny, thank you so much for these insights. Bloomberg Seoul Bureau Editor Denny Thomas. We have more ahead on the Asia trade. This is Bloomberg. Quick look at U.S. cross assets as we pass the Trump administration's policies, not just because of tariffs, but also domestically. I mean, you're hearing him indicating he'll make changes to his administration's deportation crackdown in Minnesota. And this follows on from nationwide uproar, really, over the killing of 2 U.S. citizens during the immigration raid. So let's bring in Bloomberg Chief Asia Correspondent Rosalind Matheson. So, Ross, is there that pressure from the Republicans now filtering through into a sort of reversal for the U.S. president?
Well, it does seem to be the case that he's responding a bit to the concerns that you see in the conservative ranks. I mean, lots of Americans do support a tougher stance on immigration, but there's a level of concern about the tactics that are being used and the violence that we've seen, obviously, in Minnesota, including the shootings of U.S. citizens. And so concern about that. And obviously, he's got one eye, as always, on the midterm elections, which are coming up later this year, his own polling, which is at really near historic lows, and perhaps responding to some of that. The White House distancing him a bit from some of the comments by others, saying that these people who were shot were assassins, were domestic terrorists, so walking back some of that language. And now we're seeing, of course, he's sending in his US border czar, who is relatively measured. He still supports Donald Trump's policies, but relatively measured to try and calm the situation. Donald Trump spoke with the governor and the mayor there and said he had pretty good conversations. It seems like the commander who's there for Homeland is going to be leaving. The reports he's being demoted. So a sense at least that there's some movement in the White House to recognise perhaps the level of anger that you can see in these demonstrations about these policies, and perhaps some agreement around independent investigations and so on. It doesn't mean he's backing away from his policies, though, and his hard line on immigration. Certainly he'll continue to press for that.
So then how likely is this to placate Senate Democrats that have been threatening a partial shutdown?
Well, it seems as though they're pretty determined here still, and obviously we're coming up on that deadline of January 30, and the sense that they're going to say unless you strip out this funding, including for Homeland Security, we might try and push for a shutdown. A shutdown in that case might be quite a bit shorter than the last one we saw. The question is, what does that impact? It can impact things around tax season, of course, but also the Department of Homeland Security got a massive boost last year. I mean, Donald Trump has front-loaded a lot of funding towards it, so it's not as though this action would defund this department and defund the actions of ICE. That would take really a decision by the White House to change course quite significantly. But it would be an example of the Democrats saying we're going to try and hold the White House to account on this. What would be really curious to see in all of that is, again, the Republicans in Congress. The Republicans, what do they say? What do they do? Do they express concerns? Do they stay quiet because they're concerned about Donald Trump targeting them? So do you see those conservative voices start to speak up more? That if there's a debate around a shutdown, what's going to be really interesting to watch is really the Republicans on this.
That's a good point, Ross. Thank you so much for running us through the nuances there. Bloomberg Chief Asia Correspondent Rosalind Matheson. Now on to some other headlines we're following. Major U.S. insurers plunged in after-hours trading on a U.S. proposal to hold payments to private Medicare plans flat next year. The government says the new payment rates will rise by less than 0.1%. Analysts had forecast a 6% increase. It's a significant blow for Medicare insurers facing a profit squeeze from rising care expenses and what they say is insufficient government funding. UK Prime Minister Keir Starmer says he won't choose between the US and China, and he flags significant opportunities for British businesses ahead of his trip this week to Beijing. Starmer told Bloomberg he can meet President Xi Jinping without angering Trump or harming relations with the US. Starmer told us that while the UK will maintain close ties with the US, it doesn't make sense to ignore business opportunities in China. Still ahead, our exclusive interview with the U.S. Ambassador to China, David Perdue, as President Trump prepares to visit Beijing in April. That interview coming up on Insight with Haslinda Amin and The Times on your screen. More ahead on the Asia trade. This is Bloomberg.
Keep an eye on tech stocks across Asia after we saw gains on the Wall Street session. Of course, we are headed towards big tech earnings. The Magnificent Seven recently has trailed the S&P 500. But still, we are expecting some of those big names to report later this week, including Microsoft, Meta, Tesla, not to mention Apple. You can see a little bit of divergence right now among tech stocks across Asia, especially given the tariff threats coming from President Trump on South Korean goods. Samsung Electronics to the downside. Of course, it's already rallied a lot recently, given expectations of Nvidia's approval for that key HBM4 AI chips. But staying with tech and, of course, the AI theme, Microsoft has unveiled its next generation AI chip. The Maya 200 is part of a push to power services more efficiently and reduce reliance on Nvidia products. Our Asia tech correspondent Annabelle Jewelers joins us now from Hong Kong. Annabelle, what do we know?
Yeah, well, we just know how important it is essentially for a cloud computing provider and any cloud computing provider to be able to have the best models, the best performance, the lowest costs. And that's exactly what Microsoft is working on here, because they've just rolled out this new AI chip. As you said, it's called the Maya 200, and it's silicon that's been designed specifically for inferencing very large models. So we're talking about running trained models that are already in production rather than training them from scratch. So this is the point where you really need to be able to serve millions of customers simultaneously, essentially. So you're looking at speed, throughput, power efficiency. These are all sort of the key metrics. So the Maya 200, they're saying that Microsoft is saying it can do exactly that. They're saying it's much faster, it's more powerful compared to the previous generation, and also that it's a lot cheaper. They're saying it's 30% cheaper than any other comparable AI silicon that's on the market today. So these are going to be chips that are going to be used for for powering its Microsoft Copilot assistant for businesses, as well as AI models like OpenAI's one, for instance. And then Microsoft, of course, is running or renting that rather to their key customers from the cloud. So our Bloomberg intelligence team is looking at this as well, and they're saying that it's really going to help bring down the inferencing costs for those services. It could actually end up boosting adoption as well over the coming 12 to 24 months. The market reaction we saw with Microsoft just fractionally higher in the intraday session, but importantly as well, higher than when we saw other tech stocks to the downside. And again, just going back to that importance of its cloud revenue or its cloud business, because we've got those earnings, as you said, Shery, coming up later this week, and we're definitely going to be watching Azure in particular.
In the meantime, with regards to market reaction, we saw that, right, playing out after we heard how Nvidia is upping its investment in its key customer, CoreWeave. Why?
Yeah, that's right. We saw CoreWeave definitely rising intraday in the session. Nvidia was fractionally higher, but still closed in the red. But essentially here, this is a long-standing partnership between these two companies, CoreWeave and Nvidia. Stretches back several years. We last saw a big investment pledge in September of 2025. But coming into this year, yes, we've got an additional $2 billion being put into the business here. So that's Nvidia purchasing CoreWeave stock at $87.20 per share. It is or has the goal essentially of helping CoreWeave build out an additional 5 gigawatts of AI computing capacity through the end of the decade. So you can see the Nvidia CEO Jensen Huang reflecting on why they chose to make this investment in the business. As you said, that market reaction, we saw CoreWeave rising intraday in the session, but it certainly does put the spotlight on a new business avenue for Nvidia as well, because we know that Nvidia leads the market for GPUs, or essentially the chips that are used to run AI models and develop them as well. But a CPU, and this is the one that's being marketed under Vera for Nvidia, is often described as the brains of the computer. And CoreWeave essentially is going to be among the first to deploy the upcoming or the forthcoming Vera product that's going to be offered on a standalone basis. It's the first time we've ever seen that for Nvidia. So again, just something else to watch from this accord.
Annabelle Jewelers there with the latest on tech. And do keep an eye on trading in South Korea. We're seeing a little bit of that divergence with the Kosdaq continuing to rally already at the highest level since September of 2000. The Kospi is now turning green and gaining ground. And as our colleague from MLive, Garfield Reynolds, says, perhaps leaning on the taco trade. We know that President Trump's tariff threats, according to Bloomberg Economics, have only been executed 27% of the time since the election in 2024. We have more ahead on the Asia trade. This is Bloomberg. Take a look at trading in the currency space. Of course, the U.S. dollar already was hitting the lowest levels in 4 months in the dollar index. The Bloomberg dollar index already at a 2022 low, although we're seeing a little bit of upside given, of course, safe haven concerns, as well as President Trump is now threatening more tariffs on South Korea. In the meantime, given the weakness that we have seen in the greenback, emerging market currencies have hit record highs. A little bit of downside in the early Asia session as the Korean won is also under pressure. 14.51 is your level. Let's get more now with Bloomberg FX and rate strategist David Finnerty, and our emerging markets macro strategist Marcus Wong as well. Marcus, let me start with you because, of course, we're getting the first reaction in the Korean markets given the 25% tariff threats coming from President Trump. What do you make of the moves?
Well, I think the moves there, I think it opened about 0.7 lower. I mean, hardly levels that signal stress in the market. What I would say is this. I mean, Trump is well known for making these threats. And, I think the taco trade, some would say, is quite out and alive in the market. I mean, you just recall just maybe a week or 2 weeks back when he threatened tariffs on EU over Greenland. Where are we right now? So I think the market's taking it with stride. Of course, people are concerned, and we've seen some reaction yen. But I think the bigger thing to look out for the won essentially is the possible intervention from Japanese authorities that we saw. The speculation that started from last week. I remember that I think the won and the yen has the highest correlation in emerging Asia. So moves in any rallies in the yen would correspondingly see moves in the won. We've already seen a bit of it on Monday, where it rallied by over 2% or so. One link that people bring about is the fact that both nations have pledged sizable investments into the US, 550 billion for Japan, whereas 350 billion for Korea. So 350 billion for Korea. So point of this is that any moves we see in the yen in the world will spill over to the won.
Yeah, good point. I mean, won more correlated to the yen than it is perhaps to the yuan renminbi. Now, David, let's bring you in. When it comes to the yen rally, I mean, we've been talking about how it really needs to see some follow through in terms of intervention.
Yes, I mean, if you look around it, the yen rallied to basically yesterday about a high of 153.16, I think it was. And since then, it's come off a bit. It's about 154, just above 154. So the market seems to have settled down. It's had that knee-jerk reaction for it. But you think if it's going to rally further, there's got to be some real stimulus to that, or an added catalyst, shall we say. I mean, if you go back to the question back a week ago, it was dollar yen higher. And from the yen side of the equation, nothing's really changed. We're still worried about Takaichi, what stimulus she may do, the Bank of Japan, so no rate hike. So that side of the equation, nothing's changed, and it doesn't look like anything's going to change anytime soon. So for dollar yen ready to push lower, you go, well, where does it come from? Does it come from the dollar side of the equation? Unless there's some intervention. So we're looking for intervention. We're obviously looking for how the Federal Reserve, hawkish or dovish it sounds tomorrow, and obviously how the market reacts to potentially another US government shutdown. But if it dodges those events and you end up sort of around 154 again, then you go, okay, well, we're back into the market tends to, in these scenarios, historically, it goes, well, dollar yen tends to drift back higher. So if there's no intervention, and it dodges the Fed and it dodges the government shutdown sort of bullet, shall we say, then does the market start to push it up again to test this connection?
David, I guess it takes me to my question, what's really fundamentally moving the FX space other than these headlines? So we continue to see the knee-jerk reaction in these currencies, because even Brendan McKenna from Wells Fargo was saying just because of Trump's tariff threats on South Korea that he's waiting to hear from Secretary Bessent, and he's calling this a best intervention because he usually advocates for FX stability. So what should investors be on the lookout for? If it's the market fundamentals that we've talked about, or also just more, commentary from different sections of the Trump administration?
I think certainly the economic fundamentals will always play a key part. That's never going to change. What happens is these headlines that come out, and certainly Scott Bessent wields a lot of power. So if he talks about currencies and levels, then the market is certainly listening to that. Now, of course, you don't know when he's going to say that or if he's going to say that. So, but it's certainly something that's watched out. Obviously, if President Trump says something on currencies, then markets are aware of that. But beyond that, at the moment, it still goes to, okay, let's go back to the basics. The basics are economic fundamentals. What are central banks doing? And I said we have that at the moment with the Federal Reserve looming tomorrow. How hawkish or dovish does it sound? The market is looking for basically 2 more rate cuts this year. Of course, the catch will be, even if the Fed sounds a bit hawkish tomorrow, the market you go, well, let's see who the next Fed governor is and how hawkish they are, because you'd expect them to be to some degree a bit of a dove, given obviously President Trump will pick them. So that could be the reality, the biggest catalyst for a dollar move up or down moving forward, because obviously that will have repercussions back on those economic fundamentals. So there's a lot of things going on. Headlines will always move the markets, but the economic fundamentals will always have the long-term play of where currencies go.
Marcus, do similar rules apply to EM currencies in terms of focus on, I guess in this case, fundamentals means the carry trade attractiveness versus this headline surfing we've been seeing?
Well, I think the carry is always there. I mean, has been there for quite a while. And I think, it's fair to say that, investors are pouring into EM currencies because it's just offering better yield. But I think on the funder side of the equation, that's the thing that's been more interesting in a sense. Of course, there are questions of whether the dollar debasement trade is back. We've seen questions about it, surfacing again over the past few days or so. And I think on that front, we've seen, the MSCI EM currency index actually rise to a record, just this week. It could actually push further highs moving forward. So aside from the dollar angle, that you could possibly see dollar weakness moving forward, there are other things anchoring, emerging market currencies, including, the fact that PBOC is expected to guide the yuan stronger over time. That is expected to be another catalyst that will help EM currencies in general, especially in Asia.
Team, fantastic. Thank you so much. Our FX and rate strategist, David Finnerty, and emerging markets macro strategist, Marcus Wong. Now let's take a look at how Australian markets are faring as well. We have been seeing the rally in miners in particular, given what the commodity space is doing, right? We've been seeing the gold rally also underway, continuing to climb now. Silver, despite that intraday collapse, it's back to those winning ways. Overall, you are seeing that relative outperformance in miners down under. Taking a look as well at how that has in a way impacted EM stocks. If you look at the correlation here on this chart, that is also seen as partially what's been driving EM equities and helped along perhaps by the softness overall that we've been seeing in the dollar. Shery?
Yeah, let's turn to some of the top core stories because we're also following really what's happening on the rare earth space. USA Rare Earth has signed a non-binding deal with the U.S. Commerce Department for $1.6 billion to boost domestic production. The funds will support mining, processing, metal making, and magnet manufacturing, including a new mine in Texas. The investment is part of the White House push to expand the U.S. supply of key minerals. A Zijin mining subsidiary is buying Canada-registered Allied Gold for $4 billion, adding 3 operating mines to the Chinese firm's portfolio. Allied produces gold assets in Mali and the Ivory Coast and is developing a project in Ethiopia. The deal is one of the largest Chinese acquisitions of a Canadian mining company and still requires approvals from shareholders and regulators. Chinese sportswear giant Anta Sports is buying about 29% of Puma, making it the German sports brand's biggest shareholder. Anta says the $1.8 billion purchase is a key step in the company's multi-brand and globalization strategy. Bloomberg News reported in November that Anta was among companies exploring a potential takeover of Puma. We have more ahead on the Asia trade. This is Bloomberg.
Well, wealthy Australians are pouring more money into private markets. That's an asset class that has been in focus with a growing number of high net worth individuals allocating to private assets, according to LGT Wealth Management. Investors also becoming more hands-on as they search for alternatives. And this shift comes even as global credit risks rise and direct lending faces scrutiny following the collapse of U.S. borrowers, including First Brands and Tricolor. Bloomberg Intelligence says those bankruptcies related to private markets are isolated and not systemic. Alternative asset manager Blue Owl continues to see strong momentum in the space. Joining us now in Sydney is James Clarke, Blue Owl's global head of institutional capital. And James, great to have you. We know you're on
Avril,
the
thanks
cusp
for having
of
me.
an even bigger push on the Australian markets. Thanks for being here. Talk to us first about how you're approaching Australia as a market, because whether you're looking at scale, sector focus, or lending, the sort of standards, I think US and Australian markets, they vary quite a bit.
Yeah, look, I think everything that we do, Avril, in relation to working with institutions and wealth investors is about what's our role in their overall portfolio. There's often a lot of debate about public v private markets. It's not an or, it's an and. They both can coexist together. And what private markets essentially deliver for institutional and wealth investors is actually diversification. Diversification is about the only free lunch you get as an investor investor. And if you think about it, there's 19,000 publicly listed stocks out there. There's 140,000 private companies with earnings in excess of $100 million. So, you know, the selectivity bias really skews towards private markets, and often it gets charged with the moniker of risk, where in fact it's a great way to preserve income and generate income, and protect the downside.
Would you then say that perhaps the credit cracks that we saw last year are behind us? Do investors look past all this as they look at alternative assets as a diversifier?
Yeah, you have to remember that when an institutional investor, whether it's a sovereign wealth fund where you're at, or it's an Australian superannuation fund or a US pension, their duration is 20 to 30 years, okay? So the isolated incidents that you're talking about, whether it's Tricolor or First Brands or recently a non-sponsored alleged fraud, these are very isolated incidents. In fact, in the first two that I mentioned, First Brands and Tricolor, these were actually bank deals. These weren't done in the private markets. And if you look at default rates in the upper middle market, which is where we traffic, and the reason we do that is because we think that bigger businesses are likely to sustain cyclical shocks. The average businesses that we lend to are $300 million in EBIT in earnings and greater. The default rates have actually come down, and we're seeing a lot of positive momentum. We typically traffic in the US markets, and the US economy relatively looks strong. You've got the big beautiful bill, tax credits that are coming back. You've got monetary policy in the sense that you've had 3 rate reductions in 3 consecutive meetings, and you've got the potential to have 2 more this year. So the US still represents a very attractive opportunity, and as I said, when you're a scaled manager like us and you see everything and you become indispensable in the private markets ecosystem, you have that selectivity to generate returns and protect the downside.
And yet, James, the U.S. also presents lots of uncertainties, right? Whether it's Iran to Venezuela to Russia, and even just this morning we had the tariff threats on South Korea as well. So how do you explain this to investors, and what are institutional clients telling you?
Look, institutional clients, as I said, diversification is their friend, and they look at markets all across the globe. There has been some migration from institutional investors outside of the United States to look at other markets, but it's still proportionally a very big part of their allocation. So what we tell them is that, look, we're an investor for all seasons. Again, we're matching the duration of our assets with the duration of our investors, which is a 20 to 30-year time horizon, which is independent of administrative changes. By then, I guess we'll be on to our 5th or 6th president at the time. So who knows what's going to happen? The most important thing is diversification. And again, non-US markets do represent significant opportunity, but the US is very attractive right now. And it offers the greatest amount of selectivity, if the truth be known.
And yet, you said it, migration outside the United States. Is this being accelerated by some of President Trump's new policies and uncertainties? And where do you see that capital going?
Yeah, Shery, it's a good question. We've seen some of the capital in Europe going to Europe. We ourselves, actually, we do what's called sale-leaseback, triple net lease deals, which we've been doing, by the way, for the last 15 years. We've actually seen a very attractive opportunity in Europe ourselves. So Europe is an area that people are focusing on. There's different risks to consider in those markets, obviously. That they're not immune to geopolitical risk. But again, when you're thinking about this, you really have to hone in on playing the long game and not being whipsawed by short-term gyrations in the market. As I said, when we work with institutional investors, they're not debating different markets, or they're not debating whether it should be public or private. It's like turning a jumbo jet around in a two-car garage, right? We're talking about hundreds of billions of dollars of assets here. So again, there's always going to be interest in different markets, and there's always going to be a focus on where they can balance the portfolio to reduce the downside risk.
How much of that is going into Australia? What are you expecting specifically in demand for alternatives?
Yeah, look, we're seeing a lot of demand in alternatives. Again, I mean, Australia is one of the fastest growing markets in the world. Compulsory savings rate, as we all know, of 12%. The scale of the assets here probably represents the second largest market in the world by 2032, I believe. Private assets are a way to mitigate the downside, as I said before. And Australia, I think, represents about 18% of total allocations to private markets globally. So we see that trend continuing. And look, we were here, we're a younger firm. We were here a little bit later than everybody else. We came here in earnest in 2022. You can hear the accent. I'd been in this market for a little longer, so I had pre-existing relationships. But the Australian market is very attuned to partnership. Okay, we're not here selling funds or selling products. We're positioning partnership, and we're playing the long game here. So we're ahead of schedule as it pertains to Blue Owl investment strategies. We recognize that to be successful in this market, you can't just bring a pitch book. You actually have to bring solutions. And we're very focused on the solutions. And again, we cover 4,000 idiosyncratic pension funds, sovereign wealth funds, healthcare funds all around the world. All of them have different ways to think about it. They all have different issues relating to their portfolio. And the key point is to offer your platform in a way that bespokely meets their needs. And as a bigger manager, and our cohorts that we compete against can do it, we have the scale to be able to do that. It's much harder if you're a smaller manager to compete on that basis. So one of the trends I will say, as it pertains to Australia and globally, is that fundraising was actually down last year for private markets, okay? But with managers like ourselves, it was up a lot. And the reason is that people want fewer partnerships. They don't want to be doing funds, and they want to do it with managers for the long term, making 20 to 30 year decisions here, not 1 to 2 year.
The long game, as you say. All right, James, great to have you on the show today. And thanks for sharing some of your plans about Australia with us. And a bit of a homecoming for you as well. James Clarke, Global Head of Institutional Capital at Blue Owl. We have more on Australia ahead every Tuesday at 11:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. More ahead on the Asia trade. This is Bloomberg.
Global investment into the energy transition hit a record $2.3 trillion in 2025, with transport, renewable energy, and grid investment driving the surge. But in its largest market, China, investment in renewables fell by almost a tenth. BNEF's head of Asia Pacific, Ali Izadi, joins us to break down the numbers. Ali, so why did China's renewable energy investments decline?
So let's start with the positive drivers. Despite the fact that renewable energy investment in China declined, capacity additions actually grew. So solar additions grew by about 10% and wind capacity additions by about 32%. The reason for this is, of course, the equipment has gotten cheaper, so you're getting more bang for your buck. At the same time, China's accelerated power market reforms are actually going to slow down capacity additions starting from 2026. This, of course, pulls down investment in renewables in that market.
So maybe not so much coming down from China in terms of investments, but what APEC markets then experienced growth amid the energy transition investment last year?
So indeed, despite the fact that we saw overall investment in energy transition in China decline, the rest of Asia Pacific did really well. So the rest of APAC on an aggregate basis was up by 23% year on year. In absolute term, the largest growth was in India, which saw an increase of $9 billion worth of investment. The rest of emerging Asia also did really well, particularly Southeast Asia. We saw annual investments in Indonesia and Vietnam more than double. Pakistan remained relatively robust. Even some mature markets such as Japan, South Korea, and Australia also saw some growth.
So, Ali, what can we expect then for this year?
Yeah, so as you mentioned at the beginning, globally renewable energy investment did decline in 2025. We expect, unfortunately, the trend to continue in 2026. However, as we saw with the investment numbers for 2025, where investment in electrified transport, energy storage, the rest of energy transition make up for that decline in renewables and actually result in a positive number, we do expect the same to happen this year. So again, this year, renewables are facing headwinds, not only in China, but particularly in the US and other markets. While growth will be there, it will be slower than before. For EVs and energy storage, we expect to see significant booms again this year, which will bring up the overall energy transition investment growth to a positive territory.
Bloomberg NEF Head of APAC Research, Ali Izadi there. Great to have you with us. We continue to watch the Korean markets after President Trump's threats of 25% tariffs on South Korea goods. Of course, some of those sectors that we're watching, automakers, also pharmaceuticals. You can see a little bit of a divergence right now between the KOSPI and the KOSDAQ. The KOSPI was trading in the red at the beginning of the session, but is now gaining 0.7%. But the KOSDAQ, which was gaining ground earlier, is now under pressure, perhaps because already it hit the highest since September of 2000. We have seen a little bit of more of a widening in the stock market rally, and also perhaps investors leaning into that tackle trade when it comes to President Trump's tariffs. We have heard from Bloomberg Intelligence that of 49 President Trump tariff threats or new tariff investigations launched since the 2024 election, President Trump actually only fully executed 27% of those threats. But do keep an eye on these sectors that are moving, given, of course, the tariff concerns at the moment. The China show is next. This is Bloomberg.